So the home prices are now starting to roll over. And that's because they've been in a massive bubble. It's part of the triumvirate of bubbles. One is credit, one is real estate, and one is equities. The system is so fragile given the level of debt and this deformation of asset prices and the formation of asset bubbles that you just can't close your eyes and go to sleep and think you're going to have a fun retirement. It's not going to happen.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was last on this channel back in March, he warned that the stock market was at risk of a double-digit drop. Well, he was soon validated as stocks then fell 20% over the next month. Since then, markets have rocketed back to new all-time highs. So what does his model tell us is likely to happen from here? To find out, we've got the great good fortune to welcome back to the program money manager Michael Pento. Michael, thanks so much for joining us today.
Adam, it's always a pleasure to be with you. I'm looking forward to a great interview.
Thank you. Well, same here, my friend. I wish we had recorded some of the discussion we just had before turning the camera on here. Michael, you are a Renaissance man, and every time I talk with you, we peel back additional layers of the things that you can do, and it is so impressive. But let's focus on the skill that you're best known for, at least amongst this audience, which is your ability to peer out into the macro future and divine what's going to happen next. Let me ask you this. So, I kind of set in the intro there the fact that you were nervous. The market did correct briefly, then it's rocketed back here to new highs. Was that the correction you were worried about, or was that just the opening salvo?
Okay, so let's just go back a little bit in history so I get some context of what I have to say. So during most of 2024, I was mostly bullish. I had a rather unusual proportion of my assets were long stocks throughout most of 2024. In December of 2024, I greatly reduced my positions, my long positions. I was still long, but I greatly reduced them. It was about 10% long US assets. And the reason was because not that I knew that Liberation Day tariffs were going to knock the heck out of the stock market. I just knew based on valuation metrics that I look at and based on the fact that the T-bill rate yielded higher than what you can get on an earnings yield, I just didn't think there was much risk. The risk reward wasn't there for me and my clients. So I greatly reduced my position. And that's why we're making money in the first quarter when the market was heading down. And then April 2nd came along. And because we had these Liberation Day tariffs that were so onerous, the sectors in my model, I have 5 sectors, 5 inflation sectors that range from deflation, disinflation, stasis, to reflation, to hyperinflation. Those are the 5 sectors. And each sector has their own stocks, bonds, commodities, currencies that you can choose from, back-tested, which works best in each condition. But they're not supposed to hop around like Mexican jumping beans, if I could say that. I don't know if I'm in trouble now for saying I don't know.
You're fine. You're fine.
Thank you, Adam.
We have a highly tolerant audience here.
So I actually emailed you on April 2nd and said that my model got dramatically more defensive in 24 hours. And I got net short the market. And we did well up until April 9th. Now, April 9th, that was actually the day that Trump implemented his Liberation Day tariffs. Mm-hmm. And his Liberation Day lasted 12 hours. When he saw, I think he calls it yippee, a yippee market, yippee bond market, whatever it was. But
yeah, it got the yips. Yep.
Got the yips. And he just suspended tariffs for 90 days, 3 months. And immediately my model picked up on that because I have very highly stochastic components to the model. And then I went back to where I was in late December. And that is where we stand right now. We've gotten back, we've gotten back what we lost from his Liberation Week threat. And I now remain about 10% long US equities. I have almost no shorts. I have a 2% short position. Precious metals, I have both platinum and gold, and I have some foreign exposure. But most of my portfolio, 68% of it, is in T-bills, back where it was in late December. And that is because that's what not only what my model is telling me, but think about this. If I can get a higher yield sitting in very safe, ultra safe T-bills, short-term US debt, than I can on the earnings yield on stocks, that is the most prudent place for me and my clients' money to be at the moment. But I want to be very clear about this, and we'll get to it. We have a whole hour. I love coming on with you because I can expound and you can ask.
We got the whole hour. Expound away.
Great questions. What I just said does not preclude the fact that we still have a triumvirate of bubbles. I want to talk about what happened in that Liberation Week, why that was so devastating to the credit markets, and why what my model is built to detect on. So I want to be able to do this, Adam. This is what the model, and I've been doing this 35 years. I've been licensed in this industry. Everybody has a narrative. I just gave you one. And I want to expound on my narrative. But when it comes to investing the money, I have these 20 components. And that lets me know when the handful of oligarchs that run this world, I want to know what they are doing with their money. And this model picks up on that. And I can react to it far in advance of CNBS and the rest of the crowd.
So I got to ask, what are some of the indicators that tell you when the oligarchs are making a change?
Okay, I look at the copper gold ratio. I look at the junk bond to treasury spread. I look at the 10-2 yield curve spread. I look at the 5-year break-even spread. I look at financial conditions. I mean, it's a 20-point model. I could put it. Most of it is on my website.
Yeah.
How I analyze it is proprietary. I use a second derivative model.
Right.
But let's put it this way. Let's look at the tariffs and let's look at the threat of World War III that we had recently between either you could pick Ukraine, Russia, you could pick perhaps Iran and Israel, the United States. This model was so remarkably quiescent during that entire time, outside of April 9th, after April 9th. And I viscerally didn't understand it. But I'll stick to my model because I know that the people, the multi-billionaires, the despots and oligarchs that run this globe, this planet, they will profit if they know they're going to launch an atom bomb, a dirty bomb. They know when their banking assets are deteriorating to a point where they have to act, and they'll act on it. They'll buy gold. They'll sell copper. They'll buy T-bills and sell junk bonds.
Mm-hmm.
That's how it works. And if you know that, I mean, it took me decades to realize that. If you know that, you can rest easy. Look at the valuations we have in the stock market right now. Look at the CAPE ratio at 37.8, I think it is. It's second highest in the world in the history of the stock market. If you look at over 10 years, the stock market is supposed to return negative returns in a real sense. If you look at the total market cap of equities to GDP, it's back to 210%. Price to sales, 3. These are metrics like, oh my God, I got to be out of the stock market. But why am I in there? Because I know based on what those people are doing. So everybody has their narrative. Everybody has their charts that are hard to read, and they can dazzle you with a million different things to look at. There's acronyms out there that help you invest. But if you look at the components that really matter, how these oligarchs are investing to profit from a recession, a credit market freeze, their reactions happen way in advance of what happens on the front page of the Wall Street Journal or on CNBS.
Okay, so I'm gonna um, categorize or summarize what I think your model is about, and you tell me if I get this too wrong, Michael. But when you say oligarchs, you really mean, the big money, the big money that sort of determines what's going to happen in the markets. And what you're really looking at is you're really looking at what's happening at the margin for the big money, right? Your model, as you said, it's a second derivative model, so it looks at the rate of change of rates of change, right? So, where are things changing, right? That's showing you that the puck is starting to move to a different direction, right? So, did I capture that generally correct?
I think you did an excellent job. I mean, by oligarchs, I mean like Vladimir Putin. What is he doing? What are the generals in his country of Russia doing? What is Trump going to do with tariffs? What is Trump telling his billionaire friends when he says, "Well, I'm going to put 30% tariffs on Mexico and Canada," and then the people call him up that have access to him and say, "Oh my God, what did you do?" No, no, I'm just negotiating. This will never happen.
Yeah,
So if they don't react, then I don't react
right.
because I'm not reading headlines. I'm not looking at moving averages, that stuff that doesn't work.
Okay, so you're using your model to see, okay, what are those people doing? They're the early movers, and they're usually starting the trend. So when you're concerned about valuations, the way you were headed into this year, where you're now really sitting in primarily T-bills, I mean, 68%, that's over two-thirds. Um, which stage does that tell us that your model is in? Is that disinflation?
No. So if you're in disinflation, that would be sector two. Sector one is deflation and recession, where you just sell everything. And I wanted to come on and tell you that I believe, remember I had a four horsemen of the economic apocalypse?
I do, yep.
One of those, I think, is now a three-legged stool instead of a four horseman because the US dollar has not been working the way it usually works. And we can get into that a little later if you want to, but I want to just let you know that owning the US dollar it is not going to help you.
Meaning it's
Most
not the
likely
safety
not be
trade it used to be?
it's not going to be the safe haven that it used to be. And
Hmm.
I can give you some various reasons, but we're bouncing now between sectors three and four. So they're very investable sectors. You have to be long equities. So I said 10% long US equities. That does not include an inflation hedged that I have. Basically it's an ETF that owns land that produces precious metals and natural gas and oil.
Okay.
It doesn't include being long precious metals. So I'm long platinum and I'm long gold right now. Um, and so that 10% also doesn't include foreign. I own India and I own Australia. So I have long exposure, but given that the risk reward ratio isn't there to get way over your skis, I've taken it down to 32%.
Okay. All right. So, and just to be super clear, if we're bouncing back and forth between sectors three and four, that's stasis and reflation?
Exactly. Exactly.
Okay.
Which are very investable sectors. Those are the two most investable sectors. You can invest in sector two, but you have to be very, very cautious because disinflation is not good for most stocks, especially high beta stocks. And sector one is not investable at all. That is when you want to get net, you have to be net short in the portfolio.
That's when you're in what used to be the four horsemen, but might not be the three.
Be a three-legged stool now. Um, so that would be T-bills, cash, and shorts.
Okay.
Used to
All
be
right.
instead of dollar. And sector five is stagflation or hyperinflation. And your only longs that you should be in at that point would be uh, energy and precious metals. Those are your basic hard assets. You wouldn't be long banks. You wouldn't be long any kind of fixed income. You'd be short fixed income. I have
Hmm.
ETFs that do that. Don't forget, I mean, I manage money for retirees too, so they can't short the market in a type 3 margin account. They can't have margin at all. So in the at Pentaboard rubric. So I buy ETFs that short treasury bonds and corporate bonds.
Okay. All right. Look, a lot of questions coming out of this. Let me let's get to the macro, pull up to the macro for a moment here. Okay, so ping pong between stasis and reflation. Now, reflation means some sort of positive inflationary impulse, doesn't have to be big, and a growing economy. Um, I guess the economy is growing. It looks like it might come in the mid twos or something like that right now, if we trust GDP now. Obviously, it was negative in Q1, but that had a lot of special stuff going on with front running of the tariffs and all that. But economic growth isn't like gangbusters right now. It might get there in a year or two from some of these Trump policies, but I'm going to ask you about that in a little bit. Inflation, has been, it's a mixed bag, right? I mean, it's the Fed would call it stubborn, but it's in the twos. I mean, it's not that high. Everyone has been freaked out about tariffs, but we haven't really seen much inflationary pressure from tariffs, at least not yet. So, uh, I guess, what's your outlook for economic growth and inflation as we head further into this year?
Well, one of the reasons why I was so short in equities coming into this year, if you look at the Trump's policies, border closures and deportations and the threat of tariffs, even though I had no idea they were going to be so onerous, announcement on April 2nd, that's not good for GDP growth.
Right.
A shrinking labor force. I mean, that might make the unemployment rate go down because when your denominator drops, people looking for work as a percentage of your workforce, yeah, the labor. I mean, if everybody stopped looking for jobs, the unemployment rate can be zero. That doesn't mean you have a healthy economy. But I'm looking at what's going on with student loan. Student loans are now, you have to pay your student loan back. There's some 9 million people now are delinquent on student loans.
Yeah.
FHA loans now, there's 10% FHA loans delinquent right now. And there's a lot of pressure on the middle class from it's not Adam. In my world, my belief is it is not the rate of change, that first derivative, that first change in inflation that's really important. It's the second derivative, but more important than that, it's the level of prices. 60% of this country's inhabitants, 60% of Americans have less than $1,000 in the bank, according to a recent bank rate study.
Mm-hmm.
60%. And there are studies out there that show close to 70% are living paycheck to paycheck. They have been wiped out from inflation. The fact that it's growing above 2% is an abomination. I mean, I am not on Trump's side that he should fire Powell for the fact he's not cutting rates. I think he should fire Powell for a myriad of other reasons. But but to be honest with you, why are we still, after 4 years, well over 4 years, above 2%? Why is Powell even contemplating cutting interest rates? He did cut interest rates in 2024. He cut them by 100 basis points. And the long end of the bond market said, no.
Right.
You have to deal with America's inflation problem. We have an insolvency issue in this country. We've wiped out the middle class. They are hurting. I mean, having $1,000 of net worth, 60% of the people, that's terrible. And they're still losing 2% of their purchasing power, over 2% on top of that every year. So in my mind, if I was
Right.
really
If you believe the official numbers, some say it's still a lot worse, right? Yeah.
exactly. But in my mind, in my world, Adam, stable prices means 0% inflation.
Mm-hmm.
Stable prices does not mean 2% or 2.5%. And it doesn't mean that you should be happy missing your target to the north for over 4 years, and by your own admission won't get there until 6 years elapse.
Well, okay, so so many different ways I can take this, and I think we both agree, Michael, that the Fed I think neither of us are huge fans of the Fed's track record, but that it tends to drive looking at the averages, which, in an increasingly kind of K-shaped economy like we have, the averages might be able to sort of stay propped up, but you may actually have real deterioration. If the top half of if the upper half of the K is still doing well enough, it keeps the average high, even if the much larger bottom half of the K continues to decay, right? And I think we agree we're probably much more in that type of environment right now. So I'm trying to get a sense for you is your model has these different sectors, disinflation, reflation, et cetera. And from an economic impulse, it seems from a lot of data points that the economy is slowing and has additional challenges ahead of it, at least before, it's going to be quarters or not a year or more until we get some of the oomph from some of the new Trump policies. But inflation is still remaining elevated, sticky. So how do you square those two? I mean, is that more stagflation? I mean, I guess now that I think about that, in some of our previous conversations, you were very worried that America was hurtling towards a stagflationary era.
Yeah.
Yeah, is that still the case?
Well, I mean, eventually, I mean, not right now, but eventually, I mean, let's just fast forward to April of 26. Actually, I think it's May that Mr. Powell will be graciously shown the exit door.
Hmm.
I think we're going to have a presidential puppet for a Fed chair. So I've labeled him, and I've said this for months now. I've the next Fed chair person will be an obsequious sycophant that will be willing to cut interest rates down to 1%. That's what Trump said. He said it, not me. I'm not making this up. Trump said he wants the Fed funds rate to be slashed down to 1%.
Right.
Now. He wants it now. This is when unemployment was what? Well, 4.1%. That was, by the way, that was a terrible unemployment report. I can't believe, blowout number, it was 74,000 private sector jobs. 62 or 64,000 of them were from people being hired to teach in June.
Mm-hmm.
Hours worked fell. The labor force is contracting. So it was a very anemic, weak report. It was not a strong report at all. But of course, that's why people come to thoughtful money. Because if you just read the headlines from the mainstream financial media, you would hear blowout numbers, crushing the headline expectation. But then you scratch a little bit below the surface, you go, oh boy, that was a pretty bad number. That wasn't very impressive at all.
So I'm just going to dig a little bit more on this then, and thank you, by the way, for the endorsement there. So where do you see the economy heading from here, right? I mean, I think you and I see a lot of the data the same way, right? Jobs market not nearly as robust as we're being sold that it is. Economy having definitely at least some cracks in it, but definitely maybe, some increasing amount of headwinds going forward. Though I'm happy to hear an argument otherwise.
Mm-hmm.
But, it sounds like, challenges to the economy, but still, inflation is still an unsolved puzzle here, right? It hasn't gotten down to the Fed's 2% target, which I know you think is 2% too high. And, you know, there's a lot of debate under whether tariffs are going to be inflationary or not at the end of the day. But the president continues to be, slinging out tariffs left and right. We just got a whole slew over the past week, that are going to be implemented in early August, with most of America's major trading partners. We're talking tariffs 20, 30, in some cases more percent. It's all maybe, but that's at least what's on the table right now, right? So as you look to the rest of this year, do you see continued economic slowdown but increasing inflationary pressures, or do you see something else?
I see an anemic economy. I don't see Trump's policies, and I voted for him. Please, save your emails, vituperative emails to me. I don't, not you, but anybody in this audience or the comment section. I voted for Donald Trump. He is far better than Kamala the communist would have ever been. Okay, I get it. I'm on his team, but he's extending the TCJA, Tax Cut and Jobs Act. That is going to be pretty much a stasis of the rates that are in place right now.
Yep.
Now, if you look at some of this bill is spectacular, like the 100% expensing of capital goods. I love it. Great job. But if you look at tariff rates are going from an average rate of 2% to about 15% right now. This is a fluid situation, but the best calculations that I could find is 15%. That's going to be a $600 billion increase in taxes per annum from his tax hikes, which are increasing regulations as well as increasing taxes. At the same time, he mostly extends the tax rate. So I don't see a huge fiscal boost here. And we're not getting a monetary boost because the Fed's hands are tied. Probably partially because he's being bullied, and he's like, an obdurate child who says, you know what, you want me to lower interest rates? Well, I'm not going to do it, and the other reason is because he just can't get to 2%, and that's his target. So maybe there's some semblance of sympathy he has for the middle class that he has, and I say this without reservation, he has helped destroy. And you say, well, why do you say? Are you being hyperbolic, Mr. Pento? Why would you say that? Well, why was Jerome Powell buying mortgage-backed securities in early 2022, sending interest rates on mortgages much lower and causing home prices to go through the roof, so much so that they've now priced out the first-time home buyer? As a matter of fact, before I came on today, there was a headline that came on in the mainstream financial media. 1/3 of the top 100 markets are now seeing price reduction in their houses. Yeah. 1/3 of all markets of the top 100 markets. So the home prices are now starting to roll over, and that's because they've been in a massive bubble. It's part of the triumvirate of bubbles. One is credit, one is real estate, and one is equities.
Okay, so let's actually go through each of those. So the triumvirate of bubbles. I wanted to ask you about housing, so I'm so glad you took it here. So, Michael, you've been saying that the middle class has just been getting decimated here, right? And it's something I've talked a lot about on this channel, and you and I have talked a lot about in the past. If we have what was your word? Anemic, moribund economy, something like that?
Anemic.
Yeah.
It's an anemic economy. It's not falling into recession. It's not booming. It'll be about trend growth, say 2%, give or take a little bit.
Okay, so kind of like a muddling through economy.
Yes.
Okay, so that's not adding a lot of wind to the consumer's sails. We're seeing the consumer increasingly stumble under the weight of some other insults and injuries. You mentioned student loans, right? So I've talked a lot about that on this channel, so I won't really do so here, but that is compromising the repayment of student loans, which obviously you can't dismiss in bankruptcy and they can garnish your wages. That's forcing an increasing number of borrowers to have to steal from other forms of credit payment, right? Things are tight this month. I got to pay those student loans, but maybe I'll go light on my credit card repayment, or maybe I'll skip a payment on my auto loan, or maybe I don't pay my rent, or whatever. You get that cascading effect. And I've made the argument that could be a contagion trigger that could really spill into other parts of the economy. And maybe it will be. Then we have housing, right? So to your point about housing, it's much more meaningful from a wealth effect to the average American than what's happening in the stock market, because most stocks are owned by the top 10% of households. So we're now finally really beginning to see true weakness in an increasing amount of the housing market, right? For years and years, people have said, oh, come on, you guys have been talking about this forever and prices only go up. We're now seeing in a lot of markets, especially in your home market there in Florida, of inventory really coming online in a major way. Florida and Texas are kind of ground zero for this, but it's happening in a number of other markets. And to your point, what was it? 1/3 of the top 100 housing markets are now seeing negative price declines. I've had experts on this channel like Melody Wright, who thinks like the party is just getting started. And this is, we're going to see multi-years here of lower housing prices coming along. So that's a negative wealth effect. That's going to constrain consumer spending. And, I didn't even mention layoffs yet, right? Let's even put that aside for a second. But under these increasing weights, as well as just the increase in the cost of living and the increase in the cost of debt, um, more and more consumers are starting to buckle, right? Like you get people who forget about looking for a home, people who've just been in a home and have been planning to own it, but are now just saying, I don't know if I can afford my house. My property taxes have gone up, my insurance has gone up, maintenance has gone through the roof. So how concerned are you about a even with a anemic growth, meaning it's still positive growth, it's just not big. How worried are you about the erosion of the middle and moderate classes to be able to just you know do you worry that they're going to continue to stumble even harder, even if we go along at say 2% economic growth?
I do, but I'm even more concerned about that top quintile, the top 20%, which is really keeping the economy going. They're relying on a quiescent credit market and a quiescent real estate market and a quiescent stock market. And I have my doubts that's going to continue. In fact, I'm positive. I can't, I'm not legally allowed to guarantee anything, but I can guarantee you this, that, we haven't seen the last credit crisis in this country. I'm 100% convinced. And that's when you'll break that top cohort. And that when that comes crashing down, the whole thing, the whole house of cards comes crashing down. And we do have
Okay.
a house of cards. Sorry.
No, I was just going to say, okay, so we're already starting to see some early signs that the spending of that top cohort is beginning to slow, right? And you're right. They've been, as I said earlier, they've been the ones keeping the averages high, right? Making it look from an average uh, point of view that everything's still okay. But obviously, as they start to stumble, that illusion could disappear really fast. When you say that you don't think that we've seen the last credit crisis yet, what are you worried about specifically? Like, what do you see as the likeliest instigators of a resumption of a credit crisis here?
Well, let's look what happened in that April 2nd, April 9th week. In that week, we saw the stock market drop by 15%. The S&P lost 15% of its value, and the credit markets started to seize up. No high yield debt issuance, commercial paper drying up. This is the oil, as Larry Kudlow used to say, the oil in the money markets that keeps the economy going.
Mhm.
Why did that happen? I believe it wasn't related to, we have a tariff that's going to cause a recession. That would have sent buyers into the Treasury complex, but Treasury yields spiked on the long end. And that's what Trump called yippee. Now, why
Mhm.
would that occur? So this is what I think happened. I think what happened is that the tariffs were so onerous on China. I think it was 145% or something like that, close to
It
150.
got up to that at the end, yeah.
Yeah. Where international trade would grind to a halt. International trade grinds to a halt. That means our creditor nations no longer are taking our dollars and recycling them into our bond market and our currency. If that's the case, then the demand for treasuries attenuates significantly. That caused treasury prices to drop and yields to spike. And then when you add on to it all these exotic hedge funds that are like 100-to-1 leverage, they
Mhm.
call with picking up pennies in front of a steamroller on dramatic leverage, there was a margin call in the treasury complex. And that kind of thing could happen again. I think more likely this is a what if. Well, you say, Michael, when is this going to happen? I mean, and again, and I have to say, parenthetically here, I'm an active money manager. There are times like in April 2nd when I'm net short, or in 2020 or in 2007 when I'm net short the market aggressively. And there are times when I've been bullish, like 2024, and made money. I mean, I manage money I have like 1,100 client accounts. I wouldn't have any if I was a perma bear. Okay.
Right.
I have a very good long history of making money for my clients in all macroeconomic conditions. So let me say that. But there is a grand or great reconciliation of asset prices to occur. You just can't have home price to income ratios at record highs forever. Either the home prices stay static and incomes have to rise, or there's a crash in home prices, which is much more likely to occur. You can't have the total market cap of equities to GDP be over 210% when the median metric is closer to 100%. So equity prices have to stay where they are, or GDP has to catch up for years. I don't know which one's going to occur. I think it's much more likely for asset prices to crash. That's what I think is going to happen.
Okay. So we have, I would say, we could say the real estate market is in some stage of correction here, right? Because we saw commercial real estate really take it on the chin. I don't think anybody doubts that. And then we're now seeing increasing pockets. I think pockets is maybe even too small a term to use at this point in time, but we're seeing an increasing number of regions in residential real estate that are really starting to show substantial weakness, right? The credit markets, I wouldn't say don't look like they're crashing by any stretch or correcting in any major shape or form. We have had yields be stubborn, right? I mean, the administration would love to get the 10-year down below 4%, and it hasn't wanted to. So you can say that it is pushing back, but it certainly, I don't think, is sending, imminent structural warning signs. And stocks, mixed bag. They looked pretty bulletproof until March and April. So we do have some recent memory of, okay, things weren't perfect for a little while there, but we've already whitewashed over that and we're back to all-time highs again. So I feel kind of like 2 out of your 3 aren't in any sort of danger zone at the moment. So to those folks that are saying like, all right, Michael, well, look, you've been talking a lot about these concerns of yours, but is it ever going to matter in a timeline that I'm going to care about? What do you say to them?
Well, I apologize. I forgot to finish my thought process before. I was going to say, here's something that could happen to the Treasury complex, similar to the April 2nd, 9th
Let's
week.
hear it.
So let's just say April, May 2026 comes along, and that's when Powell is shoved out the door, and we have a presidential puppet running the Federal Reserve, and he immediately slashes interest rates to 1%. I don't know how immediately you could do that with that, but say he's expeditiously gets them down to 1%. And that just shoots an arrow into the heart of people who are called the bond vigilantes. And they start selling treasuries aggressively because of this lack of concern about inflation.
Okay, so bond prices on the longer duration bonds start dropping and yields
So
start spiking.
the Fed controls the overnight interbank lending rate. That's the rate they really control. I mean, they can do Operation Twist, and they could do QE, they could do all kinds of things, but that's the rate they really control, unless they want to assent to buying every single treasury ever issued, like the Bank of Japan. Then they can probably try to seek to control long-term interest rates. But if you want to be like Japan, we could have a discussion about that, where we, have 35 years of a stock market that doesn't go anywhere, and GDP in real terms that hasn't gone anywhere since 1989. But that and what that would mean for the stock market too. But so before I get sidetracked again, and at almost 62 now, so if I get sidetracked, I don't remember where I'm talking about.
Come on, Michael, you are sharp as a tack, my friend.
You're not speaking to any Michael Green here. I just want you to know.
Well, look, I will let you know, but it's not going to happen, my friend. You're razor sharp.
Thank you. So, then we have these recession fears that are spike up. Fed cuts interest rates to 0%, goes back into QE, and the long end of the bond market begins to spike. When the long end of the bond market becomes intractable, the yields rise inexorably. Then you have to think about how that interplays with not only the credit markets, but how does that interface with real estate, which is sitting on the edge of a cliff? And how does that interface with the stock market that is so egregiously expensive in valuation? That's when I think you can get a great reconciliation of asset prices, because there's not a damn thing the Federal Reserve can do about it. The more they agree to engage in QE and helicopter money and manipulation of interest rates, the greater the concerns of inflation and insolvency. And if that's the case, the higher yields will go on the long end of the bond market. And there's nothing they can do about it. Remember, the normal way we get out of recessions and credit crises and stock market, hiccups and potholes and bear markets, the way we get out of real estate debacles is to print a whole hell of a lot of money and then give it to people, give it to banks. Then we started to giving it to people. If we do it again, I think the faith in our credit markets will be eviscerated, both from domestic and foreign sources. And that's my big fear. That is what is going to engender the next crisis.
Okay. So, to your point, the playbook is increased central planner intervention, money printing, et cetera. You think that the bond vigilantes have already started to say, hey, we're actually concerned enough that you're not getting inflation under control, that we're starting to push back on you. We could push back a lot harder, but right now we're doing what we're doing. And if Trump puts in a person who's, a yes man, that every time Trump says cut, they just say, okay, how deep? And they, they go that way. Then you think the bond vigilantes could really show up in earnest and get to the state that you talked about. And of course, this is why James Carville made that famous comment decades ago about wanting to get reincarnated as the bond market, because that's what everybody's afraid of, right? Is when the bond market's unhappy. Okay. I can see that. So let me ask you this, Michael. So, the reason why that's so toxic to everything, but you mentioned real estate and stocks, but really to everything is, on one hand, it's just academic, right? Where when you're valuing something, one of the tried and true ways of valuing an asset, at least a cash flowing asset, is a discounted cash flow model. And you have to discount future cash flows to today's present value. And the risk-free rate plays a role in that calculation. And the higher the risk-free rate goes, or the rate on, I think the 10-year treasury is the common one that they use. Higher that goes, the more you discount future cash flows back, meaning today's present value will be less, right? So that the higher those rates go, the lower asset prices should go in general. So that's sort of theory. In practice, higher rates, higher bond yields, higher credit rates, they just act as gravity on an economy, right? If we have a credit-driven economy, companies borrow all the time to do what they need to do. If that borrowing becomes more expensive, there's just less left over to do whatever you want to do with to actually grow the economy. And so, higher rates go, lower corporate profit margins go, the higher borrowing rate is for consumers, the less they can spend, the less revenue corporations make. And with their reduced profit margins, they then have to start thinking about laying people off, and you get that vicious cycle, right? So I totally understand that that fear of yours, Michael. Between now and then, is it just, Chuck Prinz just dance on the dance floor until this, monster shows its face at some point?
I mean, listen, if you want to make money, you could rest you could have your own model. I'm sure there are other models that work out there. I have my model. I'm very confident. I have my substantial assets in this model. But I want to just expound on what you said before. So people, I had there's I don't want to mention his name, but there was somebody on Bloomberg the other day saying, there's no bubbles out there at all. There's no credit bubble, and there's no over leverage in the system. And I said, So I went back and I pulled up the Z.1, all right? It just gives you the amount of debt outstanding. And if you look at the current ratio, so I look at total non-financial debt as a percentage of GDP. It's currently 257%. In Q4 of 2007, it was 234%. So that was right before the global financial crisis and the real
Mm-hmm.
estate bubble. And then in 2000, it was 189%.
Hmm.
So we have the greatest amount of non-financial debt, not just nominally speaking, but as a percentage of GDP in history, and by a whole heck of a lot. And then you made the very, cogent and important point about the importance of the 10-year note. What kind of debt is it? Like people say, well, who cares if we have all this debt because it's public debt and it doesn't matter. Well, when the bond vigilantes come and they say, like they did in April 2nd to April 9th, maybe it was caused by tariffs, but maybe it was so much bond vigilantes. But we had the freezing up of the credit markets because of what Trump did with the level of and degree of tariffs, which was a total surprise. It froze the credit markets. And when people say, well, why does it matter if the 10-year note goes up? Well, there are other rates attached to that. Mortgage rates are attached to that.
Right.
Corporate debt is attached to the 10-year note. Student loan debt, car loans are attached to the 10-year long end of the yield curve. So this is why it's so crucial when we lose that confidence, and I have no doubt in my mind that we will. The economy will come crashing down, and as I said before, and I want to make this point very clear, what is the government going to offer to stop that from happening? They can only offer what they've always offered in the past, which is QE, ZERP, and helicopter money, which will exacerbate the problem, not fix it this time around.
Yeah. But I presume you don't think it's going to stop them from trying, right?
That's a great question. What else? What else are they going to do? I think that they were going to go to ZERP, QE, helicopter money, and then try to cap the long end of the bond market yield.
Okay.
We will buy every single debt instrument, benchmark and longer in duration, and keep it below 6% or whatever rate they choose. And that supposedly will have the bond vigilantes will cover their shorts. But what do you think that's going to do to the middle class of this country? What do you think it's going to do to inflation? When the Fed is forced to, and the Treasury is forced to join into that unholy union of helicopter money, where they're just buying debt just to make sure the interest rate doesn't go higher. We're in for a very destructive time in this country, and it's precisely because of these decades. Listen, here's the most important thing, if I could, well, hopefully one of the most important things I can tell you in this interview. We had a very unusual situation happen between 2002 and 2022. For those 20 years, we had, for the vast majority of that duration of time, 2 decades, we had negative real interest rates. That has never happened before. The only time in history that was even remotely comparable was 74 to 79. And that helped engender the debacle. I mean, you're too young. You don't remember the 80s, just based on how young you look. But if you were around in the early 80s, you remember the late 70s, early 80s, the stagflation and the destruction that this country went under? Gas lines and odd and even license plates. And this was just you couldn't get a job. And I remember when I was in high school, my mother told me to get a job. I had to get a job at Burger King. Eventually, I couldn't find a job. There was no help wanted signs anywhere. The labor market was a disaster. We had over 10% in unemployment rate. These are the things that you have to think about when you look at, everything's great right now. Everything's wonderful. Well, it is. But have a model, have a robust model, and be on guard, be on the lookout for the things that I am looking at. Because when these people that actually run the world, the oligarchs and despots, and multi-billion-dollar hedge fund managers and the people that run the biggest banks in the globe, when they get nervous, they take action. I want to know right after that happens.
Okay. All right. So I'm going to, we're going to talk a little bit more about exactly this. Then I want to get to what you're doing in the here and now, because to a certain extent, while you have extreme confidence that the system is going to lose confidence in the system at some point, the timing of that obviously is unknowable.
Right.
So I want to know, I'm going to want to ask you in a second what you're doing in the interim. But Michael, as I hear you talk about this, yeah, I want to note for folks that there are, we're talking about something that's going to happen in the future that we don't know exactly when it's going to happen when. So don't like sell everything you have and position for this outcome
No,
today.
exactly. Don't
As
do it.
Michael's shaking his head, yeah, you can get killed 6 ways to Sunday before this thing actually plays out. And as I hear you talk, Michael, I feel like when your model tells you, okay, it's going down, right? We see the bond yield spike and the wheels are coming off in the way that you thought they would. That's the time to get into sector one deflation positioning, right? And that's in your three horsemen, maybe four if the dollar's, return to its old ways, but maybe not. But then when the central planning response starts, I presume you want to jump into hyperinflation.
Sector
Sector
five.
five.
Yes.
Yeah. Okay, good. So I'm taking good notes.
Yep.
All
You're
right.
right. You're the best.
Okay, good. All right. And this is also instructive for folks too, I think, to see how dynamic your model is, right? Okay. So speaking of the dynamism of your model, we're not in sector one yet. And we don't necessarily see it happening anytime imminently. At least your warning signs aren't saying, it's something that you see, in the near term horizon. So how do you plan to play the rest of this year?
Well, first of all, this is July, so I'm not going to say what I'm going to be doing in December, but I will tell you where I am right now. And I think I mentioned it before. 68% T-bills. We have about 10%, maybe a little less in foreign equities. We've got the inflation hedge. We've got platinum and gold, 5% each in that. And we have, yeah, 2%, just a
2%
2%,
shorts, right?
2%. It really, and not even really a short. It's a whitewash short. But I just want to comment on what you said before about preparing for this. It's very crucial that people aren't out there shorting the market right now, or doing something silly like just buying 100% and put 100% of their money in the long end of the bond market. I am very convinced that unlike other occasions where you could sit in sector one for multiple quarters. Like you think about the global financial crisis, you could have sat in sector one from like Q3 or Q2 or Q3 of '08 all the way to Q1 of 2009. So several quarters. I believe this time around it'll be a truncated sector one, which you so adroitly picked up on. It will be a truncated sector one, which could morph quickly to sector five, where you have to be short the long end of the bond market and you have to be overly aggressive in your energy exposure, your uranium, your natural gas. And short all the shorts in your portfolio should be the anything linked to fixed income, anything that derives its valuation from fixed income, because I think
Mhm.
it could be a disaster, an unmitigated disaster. And I think it could be something that this country has never even before imagined could happen to the stock market. That's how bad I think it could. That's how bad I think it could be. And
Okay,
I'm not
and
trying to scare people. I'm not using hyperbole. I'm 35 years licensed in this business. And I understand people say, a lot of my friends think, like, why can't you just be happy? Why can't you just like, because when you have the amount of debt that we have in the system, both public and private, and things like we haven't even talked about private credit. Um, you try hitting a recession, and then trying to sell an illiquid asset that hardly ever existed before. And that now there's,
Right.
$1.5 trillion, probably more in private credit and private equity and all sorts of exogenous, things, derivatives in the stock market that we don't even understand. That listen, someone has to. If I am a Cassandra, then explain to me what happened between April 2nd and April 9th. Why did we lose 15% of the value of the S&P 500 in a handful of trading days? Why is it the credit? How is it possible? We have plenty of reserves in the system. The reverse repo facility still has couple hundred billion left in it, like 180 billion left in it. Why we still have the standing repo facility for banks? What happened? The system is so fragile given the level of debt and this deformation of asset prices and the formation of asset bubbles that you just can't close your eyes and go to sleep and think you're going to have a fun retirement. It's not going to happen.
Well, all right. Very well said. Let me ask you this, Michael. So, I have other guests on this program who share similar concerns. Um, I guess, sorry, two questions. First off, you said you're not sure that people are even able to imagine the magnitude of what this correction might be, and you're not trying to be histrionic, but you think it could be really big. I've had you on the program in the past, and you've said things like, yeah, for the market to get back to like true fair value, whatever, I mean, it really would need to be lose like 40 or 50%. I think you're thinking, and what you're talking about here could be potentially even larger, at least in its initial phases, right? Where, I mean, what did we lose in the 1929 crash? I mean, that was more like
We lost. Well,
85.
we lost. Well, when the market wasn't in a bubble in the global financial crisis, 2007, we lost 50% in the S&P. We lost 83% in the Nasdaq debacle. That was a bubble. It took how many years? With 25 years, 1929 to 1954, I think it was, before we got back to even. I mean, who has
Right.
that kind of time any longer?
Time. Yeah.
So yeah, I would not, and listen, people, you don't just usually correct back to the mean. So, I mean, if the total market cap of equities is 200% and it's usually 100%, you have to lose 50% of the value of the stock market to get back to even. And
Right.
who's to say it's going to stop at down 50%? I don't know. And making predictions like this can sometimes make you sound really foolish. All I can tell you is the system is in place. The ingredients are in place for a massive and significant and quick correction, an expedited correction in the stock market. And you have to be extremely vigilant to avoid it when it happens. And history is replete with examples of this. And it's gotten worse since 2002 because we have never had such a gross financialization
Creation.
of asset prices. And the progenitor of that has been the Federal Reserve, who brought interest rates in real terms in negative territory for the vast majority of those 2 decades.
Right.
Never before happened.
And one of the perverse outcomes of that, right, is this sort of recency bias that I think we have in the markets right now, where um, since the early 2000s, it's pretty much been up and to the right, right? It's the buy the dip, just hold, everything's going to be fine, right? And so, um, you know, that's what investors have gotten conditioned to do, right? Stocks
Mhm.
are safe assets.
Mhm.
I should always expect them pretty much to go up. Yeah, I kind of remember there were just a couple of periods in there where things weren't perfect for a little bit, but then the Fed and the other central planners stepped in and they did what they needed to get us back to all-time highs. So we kind of tend to forget how terrifying it felt during the global financial crisis, during COVID, briefly, whatever. And so, uh, people get more and more conditioned just to be increasingly long. And I saw a scary stat this morning, Michael, that uh, uh, from a percent of ownership of stocks, U.S. households have never been more long
Yeah.
stocks than they are right now, right? And the scary
Yep.
part is amongst them, when you look at the retirement accounts, um, the 50 to 80% cohort um, is more in stocks, is a higher percent of being in stocks than anybody else. So the cohort that is closest to retiring,
Retirement,
right?
yes.
The cohort that should be prioritizing conservatism, balance in their portfolio, ballast, low beta investments to cushion any sort of market downturn. They're more aggressive in stocks than they ever have been, and they're more exposed to stocks than the other younger generations. So everybody is just all in on
Hmm.
this party continuing. So to your point, if what you think could happen, it's going to be disastrous in the sense that it's going to catch the vast majority of people by surprise, and it's probably going to catch those who can least afford to lose both
Hmm.
the money, but also the time, because they don't have the time to rebuild it. It's going to hurt them the most.
So the government has successfully inculcated to the individuals. They're the ones supporting this market right now. It's not even the institutions any longer. The institutions have been, basically out of this recent rally. It's the individual investor has been thoroughly, in Pavlovian fashion, inculcated into buying every dip. I have the conversations. I see it in the data, the Charles Schwab data, what you just mentioned. I wrote about a couple of weeks ago. The percentage of assets that are owned by the public close to retirement is the worst cohort, correct? And what I can envision happening is, and these are all automatic.
Mhm.
These are automatic buying orders that come in from funding their 401k plan. What I can envision happening is the market drops 30% because of the recession or liquidity crisis, or combination of both, rising, spiking long-term bond yields. And then they're forced to panic. They call their 401k plan administrator at the exact wrong time and say, listen, I need to get out. I'm approaching retirement. I need to go into cash right away, which exacerbates to a great degree, puts into reverse that endless, blind, dumb bid that keeps going into, the
Mike
market
Green's
cap
giant mindless
weighted,
robot. Yeah.
the mindless robot, which overemphasizes owning the highest capitalization weighted stocks in the S&P.
Yeah.
And then there's just no bids. Now it goes into reverse and there's no buyers. There's no bids.
Right. And that
And
becomes
that's
just
way that's
a
how you get
vicious
50,
cycle.
60, 80, God forbid that happen. But listen, I mean that you people who would deride me would, that's fine. That's fine if they can do that. I just think they're ignorant to history. Understand your history, not only the United States, but international history of stock markets. And you'll see what I'm saying is absolutely replete and very, very probable, replete through history and probable to occur here in the United States.
Okay. All right. Let me just ask you one counter question, and we'll start to wrap things up, Michael. So there are some that would say, Michael, like, look, uh, economy's doing fine, right? We got decent growth, unemployment's still really low. Um, and look, we've got the cavalry on its way. AI is going to be amazingly transformative to the economy in ways that we can't even imagine now, but we can certainly see that it's going to make companies so much more efficient, and it's going to help boost profit margins. So, maybe these higher multiples that we have are just the new normal going forward. Maybe they even need to go higher because of all the benefits of technology that are coming. And hey, we've got a real business-friendly commander in chief, and he's just pushed through the major things that he wanted to get done. He's reforming trade. We're going to get better trade deals. We're getting tariff revenue that we didn't get before. Um, we got this one big beautiful bill passed, and the tax cuts are permanent. We got additional tax cuts. We got deregulation that's going to help a million flowers bloom in the economy. And that stuff we're going to start seeing, 2, 3 quarters from now, we're just going to get an increasing tailwind at our backs from that stuff. So, Michael, like, how can you not see this beautiful new golden age for America ahead?
Well, I mean, I don't think you can have it both ways when the people say, well, tariff revenue is coming in. That's wonderful. Well, yeah, it is wonderful, but tariffs are taxes. And so now we're espousing tax hikes are great for the economy. So you can't have it both ways. They're either good or they're bad. AI, I think, is a wonderful technology. It's one of the best we've ever had, maybe despite, maybe second to electricity. But when you have these massive transformations in technology, it depends on the speed. I like to look at like the cotton gin. Eli Whitney invented the cotton gin. Well, they gradually replaced the mass of agricultural workers over maybe several years and decades. It didn't happen in the space of a few quarters or months. And if AI is going to happen expeditiously and the adoption causes mass unemployment to happen, unemployment to occur, you can have a very disruptive period in this country rather than one that's a green light and a boost to growth from the get-go. So I also want to caution about that. But you're correct. I mean, I didn't say the economy's falling off a cliff. I am saying that half of GDP growth is what's happening with the labor force, and the labor force is shrinking. So all you have left is productivity growth. And if AI kicks in and supplants the fall in the labor force growth, that means it's also laying off a lot of workers, a lot of white collar jobs is probably what's going to happen. So when you add it up and put it in the sausage grinder and grind all the meat out, you come up with the conclusion that you're going to have an anemic economy, but not one that's imminently falling off a cliff. That's where I stand.
Okay.
And I've looked at all of the positives and all of the negatives, and I've rolled them all together, and I came up with my own narrative. But the model tells me and agrees with my narrative. When the model agrees with my narrative, I feel very comfortable. We're gonna have a muddling economy. It's not gonna boom, and we're not about to fall off the cliff. But I went through the scenarios on this interview where I think that has to change and why it could change significantly in 2026.
Yeah. Yeah.
Or even before. But there's a good case that it could happen in 2026. And the progenitor of that, the catalyst could be the removal of our current Federal Reserve chairperson.
Yeah. Yeah. And I understand the rationale for that. So whatever happens, my friend, I want to thank you in advance for keeping us updated on how you see things unfolding from here. I really value the work of folks like you in terms of having, all the work you put into building your models. Because as you like to say, Michael, your model doesn't really care how Michael Pento feels on any given morning when he wakes up and reads the headlines and gets emotionally impacted by them. The model keeps you grounded and tells you what it thinks is most likely to happen next from here. So as I always ask you to, and you're so good about doing it, when your model has a substantial sector amendment to it, after you let your paying clients know, please let us know and come back on here and give us the update. But whatever happens between now and then, it's going to be an interesting ride, I'm sure, for that.
Yes, I guarantee you, I will do that for you. Anything.
You're so kind. Well, okay, so let's talk about what this audience can do for you for a second, Michael. So for folks that have very much enjoyed this conversation, as I know folks always enjoy your conversations, and if they'd like to follow you in your work, learn more about you, maybe talk to you about your services there at not Pentonomics, but Pento Portfolio, where should they go?
So here, I'll help you out.
Thank you.
Pentoport.com is the website. On it, if you don't have $100,000 to invest and you're not a US citizen, you can avail yourself to the midweek reality check, which gives you the important salient data points, macroeconomic data points of the week and how I interpret them and what you should know. That's only $50 a year. And if you can become a client, we'll bring you on to the IDEC portfolio, which is the inflation, deflation, economic cycle portfolio, which I will personally manage your money in that structure according to the paradigm models output.
All right, my friend. And when I edit this, as usual, I'll put up the links to your website there on the screen, and I'll put that link as well as the link to your podcast that you mentioned in the description below this video, so folks can get to each with just a single click. Michael, my friend, it is always such a joy to have you on. Let's do it again soon. But like I said, the door is always open. If you see some material change on the horizon that you want to let everybody know about. As we wrap up here, what would your parting bits of advice be to this audience, which is mostly made up of regular people, many of the same type that you manage money for, Michael, who are, you know, trying to navigate the markets we have and hopefully prudently growing their wealth, but more importantly, they just don't want to get eviscerated if and when a big market reckoning like you think, could happen in the future happens.
I would say keep watching your channel.
You're so kind. Yeah.
That's my best advice. Yeah. You've been a blessing to me. You've been a blessing to this country, and I thank you for your work you're doing and continue to do. You're tirelessly working and making sure as many people are prepared for the eventuality of this great reconciliation of asset prices. And you've got plenty of people on your program that have models that are active managers. I think that's what I can leave people with. Find
Okay.
yourself a good active manager with a robust model who's not going to just say, like 95% of Wall Street will do, they're just salespeople. I call them used carpet salespeople. They will take your money, closet index the S&P 500, try to shadow that. And when it collapses, tell you, don't worry, it always comes back.
Yeah.
That's what they do. And they charge you a fee for that. If that's your philosophy, just buy SHY, which is the ETF for the S&P 500, and maybe throw some fixed income in there, depending on your age, TLT, and maybe not SHY, SPY. I'm sorry. SHY is a short duration ETF. TLT is a long duration treasury ETF, and SPY is the S&P 500 ETF. And then you could just go off and play golf if you don't care about what's happening. But if you understand how fragile markets are, you need an active manager with a very robust strategy. And that's the best thing you can do for you and your family to ensure you have a very comfortable and safe retirement.
Very well said, my friend. I make the pitch on this channel often for the average retail investor. If they don't have a really good track record as being a successful DIY investor, especially through volatile years like we've had this year, or environments like you think could be coming ahead, they're much better served not stressing about, okay, what's the next asset I should add to my portfolio, and they'd be much better served really focusing their analysis on, hey, who would be the best manager to serve as my financial quarterback through all this. So I completely echo everything that you just said. Folks, I swear that wasn't the setup. I didn't ask Michael that question just so he could very kindly say some nice things about me in this channel. But I do want to say, Michael, I just got back from a conference from Rick Rule's annual symposium out there in your home state, and really wish we had time to get together while I was out there, but we'll remedy that next time. But I was so just blessed to be approached by so many people just in the hallways, thanking me for thoughtful money and for what this channel does. And a huge part of that had nothing to do with me, but it was for the people that come, the experts that come on this channel and share so much of their expertise and their wisdom and their insights and intelligence with this audience. And Michael, you're one of the names that's at the top of that list. I just want you to know that you are extremely appreciated, not just by me, but the entire Thoughtful Money audience here.
I really appreciate that, and I hope you understand too. And I say this complete sincerity, what a blessing you've been to so many people, and you are excellent at what you do. And I really appreciate being a small part of what you're doing, Adam. I look forward to continuing that for as long as you'll have me. Thank you.
Well, thank you. All right, folks, we'll wrap up this Mutual Appreciation Society, but the only thing I'll contradict you on there, Michael, is you are not a small part of it. You are a large part of it. All right, with that being said, my friend, thank you so much. Like I said, doors always open for you. At a minimum, we'll see you back here in a month or two. And in the interim, hopefully you and I can find some time to get together in the real world and play a little pickleball together.
Okay, well, hopefully, I know you're a 5-0, so hopefully you'll take it easy on me.
Yeah, I wish. All right. We'll answer that question on the court. All right, Michael, thanks so much, buddy. All right. Well, now's the time on the program where we bring in the lead partners of New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. We're going to have them hear their reaction to the interview I just did with Michael, and then we'll talk about what the markets have been up to over the past week. I'm joined as usual by lead partners John Lodra and Mike Preston. Boys, great to see you again. Mike, why don't we start with you? What were some of your key reactions to Mr. Pento there?
Hello, Adam. Good to see you, and thanks for having us here today. This is not the first time that we've followed Mike Pento's interview with you. There's been at least several times over the last few years, and we've got a lot of respect for Mike because he's one of the managers that at least attempts to be tactical and active, and he seems to get it where we are in the cycle. You know, when I say by get it, he understands the following points that he reiterated in his talk. That he says the risk reward for equities just hasn't been there. Yet we're forced to play the game to some extent because the oligarchs are driving this. Now, I'm using my own words, not Michael's, so don't quote me exactly, but he's talking about the dividend yield being low. That's another way of saying that valuations are sky high. Um, the CAPE ratio, the cyclically adjusted PE ratio is 37 or 38. It's even higher when you realize that we're living in an era here where margins are driven higher by government spending, and they probably won't be there forever. They probably won't be there 5 or 10 years from now. So the price earnings ratio, the 10-year smooth price earnings ratio, the CAPE, is 38, but it's actually probably up in the 40s when you take that into, or even the 50s when you take that into account. And yet it hasn't mattered because the oligarchs are stomping around the room, moving asset prices around. And that's what Michael was saying, is that you're almost forced to play the game. It's true. An active, mindful manager like Michael, like us, we're forced to play this game to some extent. Yet, got to be really careful because we're probably trading at 3 times normal valuations, and nobody knows when the gig is going to end. A lot of people don't think it's ever going to end. We do. And I think Michael does too. And we're all trying to just game theorize, how best to manage this path with the tools and the experience that we have. So I found that really interesting. He talks about an anemic economy. He talks about housing markets slowing down. There's some factoids in there that I haven't heard about before, so thank you, Michael, for that. He talked about 1/3 of the top 100 housing markets are now down. I did not know that. He talked about bubbles. We're fully aware of the bubbles that have been going on, credit, real estate, and equities. We've been living through the everything bubble since really the bottom of the great financial crisis in 2009. So, in general, we agree with the viewpoint that we're in a bubble. Valuations are off the reservation. Forward-looking returns over the next decade are going to be negative for passive investors. And so an active strategy makes sense. Now, how exactly you do that is important, I think. He talks about how everyone has a narrative on Wall Street. It's true. I mean, everyone's got some kind of narrative. We believe strongly in our viewpoint or our narrative that we're in end stage times for this financial cycle that we're in. We think we're entering the end of a multi-decade bull market. We think we're entering the final 5 years of a fourth turning, and the parts of the fourth turning we haven't seen yet are the crisis and the climax. So if I had to guess, I'd say that the crisis part of that fourth turning gets kicked off when the stock market tops and drops hard or even crashes. That's anyone's guess, but it's looking like energy is building for some kind of blow off here. And if we get that later this year, early next year, that could be the crisis. And then after that would be the climax of the fourth turning, and that period could take a few years. That generally means a long drawn out bear market, and investors are going to want to be tuned in during that time because the climax time is the best time to buy. But we've got a lot of runway between now and then. So yeah, I think I'll just pause there. I'm using a lot of words, but I think that Michael and we are kindred spirits. We've had the pleasure of following him on your program several times, and we've had the pleasure of speaking to him directly off camera, and we've enjoyed those conversations. So thank you.
Well, he's a good guy. You're a good guy. No surprise that you guys like each other and see the world similarly from a macro standpoint. Mike, I'm curious. So, kind of the fourth turning arc that you have there, I think a lot of viewers get, and they've heard Neil Howe on this program, specifically talking about the fourth turning. That's not really a good timing model, right? It kind of gives you the stages to potentially expect, but it doesn't really tell you what to do in the here and now with your assets. Michael said that we're in this triumvirate of bubbles. I think that was the word that he used. Um, and you mentioned even that there's likely to be a period of kind of a blow off top type period. Now we've seen from the April lows, stock prices rocket back to all-time highs. They're a little bit off them on the day that we're talking here, but they're still pretty close to all-time highs. Risk on assets like Bitcoin have shot the moon. Precious metals have continued to hang in there. Seems like kind of everything is going higher right now. Some might say, hey, it kind of feels like it's melting up right now. Does it to you, or are you thinking a melt-up phase is something a lot more extreme than what we've seen so far?
I don't really think this is what you would call a classic melt up. Some people would think that because of the fact that we're starting to see speculation. Certainly starting to see speculative fervor, speculative spirits. For instance, Bitcoin just went from 108,000 to 120,000 the other day. Silver's finally broken the triple top above 35 and went to like 39-ish, back to about 38. Nvidia is the first $4 trillion company, over I think 172 a share. It just shot straight vertical. We see a narrow market because mid caps and equal weighted S&P haven't really joined in yet, but they're starting to. It's I think that John and I would both say we've learned during our career that it's really difficult to put to call a top. It's really difficult to say just how speculative marks the top. And I just think about where we are. This is a fourth turning, a very, very large scale cycle. This is not a minor cycle. This is a climactic time. And so you're right, the fourth turning is not a good timing indicator, but it's really good to keep your head on straight and to say, yeah, it's this could get crazier, so don't be shorting this. Don't be thinking that you're too cute and you're going to pick a top here. And more importantly, too, when this thing tops and rolls over, just realize how big this cycle is, and it's not going to be a buy the dip time. So it helps for that context. So, I said that we're likely to get a further blow off top, but we're not trading from that viewpoint. We're not increasing in a big way our allocation. We're not taking risks. We realize we might be wrong. We've learned a lot of humility in this business over the years, but and there's a little bit of gut feel to this business, no matter what anyone tells you. We've got a system, but nobody knows the future. If you had a system that could print money, whoever had that system would soon have all the money in the world. So our experience and our intuition tells us we're likely to have a further blow off. And what would it look like? For me, the S&P is at 6,200, maybe 500 or 1,000 S&P points within a month, several weeks straight up. That's kind of what I'm expecting.
Okay. Well, right now, and John, I'll come over to you with this question. Right now, Michael is pretty defensively positioned. His model is, he said, ping pong back and forth between sectors 3 and 4, which is stasis and reflation. But that's got him, over 2/3 in T-bills. I know that you guys at New Harbor have been, fairly conservative in terms of having a relatively high cash allocation as well. Perhaps not as high as Michael's, though. And then similarly, having some exposure to hard assets, precious metals, et cetera, a little bit of international exposure, and then some exposure to US stocks. To Mike's point about concerns of, both just the risk of this market in general, but the fact that the market could still go higher in the short term, maybe even in a blow-off fashion. I don't get the sense that you guys are fully out of the pool. And so the question is how are you as capital managers right now, kind of dancing while the music's still playing, to borrow from Chuck Prinz, but prioritizing the ability to react quickly defensively if indeed things take a turn for the worse, as you think may happen at some point.
Adam, I think you might have teed that up for me. I'm happy to chime in there. And I don't have much to add to Mike's synopsis of Michael Pento's comments, other than I'd just like to, compliment him, for being consistently truthful about what the market data seems to be telling us. even if it's something that we've been talking about for a long time. The fact of the matter is not just things like the fourth turning philosophy or cycle analysis, but valuations that we've talked about plenty on your channel, and Michael Pento talked about in his talk with you. Those aren't good timing tools, right? We could say everything that Michael summarized there, that's been in place for the last handful of years, not just now. Yeah, there's been brief periods of moderation, but we've had extreme overvaluations of the U.S. stock market. We've had earnings yield pitifully low from any historical standpoint, but these are not good timing indicators. That's why, to give Michael another credit here, he talked about everybody having their narrative, but ultimately it comes down to having a non-narrative, data-driven process to weed through the narrative as to seek the truth. And that's very much how we would describe our process. I believe Michael's model tends to lean more towards econometric type of factors. Ours tend to lean more towards market-related factors, things like breadth and momentum and things like that. Neither right nor wrong, just different ways of looking at the same thing. All point being is that the markets can and will do things that they're not supposed to do from a fundamental standpoint for periods of time that can feel agonizing. So yeah, I mean, to answer your question, we are we're probably we're less defensive than Michael is right now at this particular moment, but I think the path was similar. I'll tell you very proudly that we're beating the S&P 500 year to date net of client fees, and we had very little drawdown in the technical bear market in the March-April timeframe. So it's been a very satisfactory forward ride for our clients, but we don't take victory laps in this business. It's all about what comes next, and that's what we constantly spend our time evaluating our data and models. So we're about 45% in equities right now. A full third of that is allocated towards international equities, which objectively are far better valuations than U.S. stocks. And finally, this year, we've started to see some true technical signals, things like relative strength, start to give a nod towards these more compelling valuations. And that hasn't mattered. The more compelling valuations haven't really mattered much of the last decade plus, but they're starting to matter now, and that may change, but we'll just read the signals as we see it. But yeah, we're only 45% in equities right now. We probably are closer to getting more defensive than more aggressive at this point. We have had a very sharp rally here. Our battery of indicators didn't register anything like off the charts extreme in terms of blow off top from that standpoint. And I want to make it very clear. Mike talked about a very likely scenario that we do see a more traditional blow off here, but that doesn't mean one needs to play that. In fact, we're not playing that. We think that's rather a fool's errand for most of our clients who we're zooming out and looking at their own situation is really what's most important, not whether you roll the dice on a late stage last gasp rally. We raise this possibility not to say you should be chasing it, but just to prepare yourself mentally for if you're being rather defensive and conservative, don't freak out about trying to chase it. In fact, it's probably going to be something that you would get very harmed by chasing because it typically is very short-lived and met with very quick pullbacks. The other thing I just want to say is not only it's really important to have a proper asset allocation, but even within the equity allocation, being in the right areas. There are areas of the market and sectors and things like that are technically and performance-wise far outpacing others. I'll give you an example. For this early this year, when the markets were a little bit weak, low volatility stocks were soundly outperforming. Value is outperforming growth. That has done an about shift for the last several months. So it's our right to be underweighted equities, especially if you're in the right strong areas. And these things change. They rotate. We're not in healthcare, for example, right now. It's the weakest sector. Energy has been a laggard, despite our belief that fundamentally, from a longer term perspective, it's likely to be a very strong performer because they're very undervalued relative to the market. We're starting to see energy exert some relative and technical progress relative to the markets. That's a sector that we have our eyes set on. Commodities that we think are really interesting right now, even broadly outside of precious metals, which we've long talked about being very, very big proponents of. And this all ties back into the big picture policy landscape that Michael Pento talked about and we talk about all the time. This fiscal, monetary, kind of trap that we've gotten ourselves in that, there probably is no way out of without some major accident eventually. But I'll pause there. Bottom line is we're about 45% in equities, about 12.5% in precious metal type investments, 5% commodities, 20, close to a quarter of the portfolios in short-term treasuries. And then we have about a 15% slice in intermediate bonds, small slice in longer-term treasuries as more of a tactical thing, and a little slice of non-US denominated sovereign credit, which is another way of hedging a weakened dollar.
Okay. I just want to try to tease something out from what you said there, John. So, understandably, there are people that will look at how quickly the market returned back to these historically stretched valuation levels. As Michael said, coming into 2025, he was positioned very defensively because his model was reacting to how stretched these valuation metrics were. That led him to basically be protected against, and then even go short, I believe, the correction that we had in March and April. And then his model flipped, and he's benefited from the rise. But he's now back in that defensive position, right? It's kind of like I'm kind of back to where we were heading into the year, right? So I think it's understandable that some people might say, "Oh my God, we're back at these stretch valuation levels. Of course, this thing's just going to have to, have some sort of violent pullback here at some point in time." And it very well may. But what I hear you saying is, actually, from a breadth perspective, we're seeing the breadth begin to get a little bit better. We're seeing, more relative outperformance in some of these other sectors that have been ignored for a long time. And so that seems, to me at least, to give some, credence to, this rally could continue or at least sustain for a bit longer here, because we're just not seeing too many traditional signs yet of the type of erosion that you expect to see before you see some sort of big market pullback. Is that true? Is that how you're seeing the markets?
Yeah, and this is all matters of degree, right? It's not; these are not black and white conclusions, right? So I'll just share.
And that's my whole point. I think
Yeah.
investors try to like to think in black and white if they can, but a lot of times it's gray, and you got to respect the gray.
Absolutely. Let me just share. This is just a glimpse of part of our dashboard, and just for context, so for example, we can look at the S&P 500, and we can see that yes, we've essentially reached all-time highs recently, right? And in a very sharp fashion. But what we see is a complexion of the market that isn't narrow. So for example, we can see that 70% of the stocks in the S&P 500 are on what we call bullish percent, buy signals. Okay. We can see that 60%, more than 50% of the stocks are trading above their 50-day moving averages, and a full 55. Where things are more concerning is where you see highs being made and these participation indicators starting to roll over in a very meaningful way, where it's kind of these indices are making highs on the back of very few stocks, and you see terminals start to really weaken and become less participatory. Now, to be clear, we've seen some early warning shots about some of those indicators starting to stall a little bit. So we're very heightenedly aware about that. And, we don't want to jump the gun here, but we may have good reason to become somewhat tactically more defensive in the near term, even if we don't get the classic blow off top, because we're not investing for that. Our clients don't need that, nor should we be investing them for that. We're investing for their timeline that matters. But how might we become more tactically defensive? Well, certainly selling some equities is one way to do that. We've talked often how we can use hedging tools, option strategies, covered calls, protective puts, and combinations thereof to do that. And that's exactly what the playbook we use to ride out the very volatile March and April without much consequence to our clients. And this is no prediction for the future to resemble the past, but we have a toolkit that if we're forget the narratives for a moment, if we follow our system, and nothing's ever perfect. You just got to be, more right than wrong by some even thin degree to do well for one's investments, and that's what we'll continue to do.
All right, Mike, let's come to you here now. We got to start wrapping up, but real quickly, I just want to let you say whatever you want to say about what's going on in the precious metals right now. You talked about how silver had broken out of its 35 to 37 range and got up to 39 something. I think on the day that we're talking, the past couple of days, we've seen some cooling off in the precious metal space. Silver, I think, is now back just under 38, at least the last time I looked at it, which was right before we started filming here. Now, of course, people look at that and say, "Oh, it's now down, a couple percent." Yeah, from 39, which, if I told you a week ago it was going to be at 39, you would have been doing backflips. So I guess my question is the uptrend still intact in the precious metals in your guys' mind, or are we starting to see anything that gives you pause?
Yeah, Adam, there's really nothing wrong with the precious metal charts. You're absolutely right. I'm going to share a chart of an ETF for silver. This is the most popular one that I'm sharing, just so you can see the shape of the chart. Here's a weekly chart, which I think shows it pretty well. This line here is right around 35 spot on silver. This is again a weekly chart, so it's been 7 weeks since this breakout. Really, this breakout above 35. And so then we've consolidated here for a few weeks. And then last week we broke up to almost, I guess, 39-ish. Right now we're at 37.85 on spot. And so right at that 38 level is it's kind of what we thought the next level would be after this breakout, the 38 to 40 level. So the chart is acting correctly, I guess, is the way to put it. And so what targets from here would you expect? It's hard to say, but if I go to the monthly chart, you can see what silver can do. It did this back in 2011. I think that silver is likely to continue in an upward trajectory, but I can say that we've reached near-term targets. So that doesn't mean it's over. It doesn't mean you shouldn't buy it if you don't own it. In fact, if you don't own any precious metals, I would buy some here, both gold and silver. Gold and or silver, and usually a mix is what we would recommend. Maybe 2/3 gold, 1/3 silver. Gold right now is trading at $3,350, so it seems to have stabilized in that $3,300 level, and silver here hovering just around 38. So, frankly, I- if you don't own any, buy 5%, 5 or 10% of your investable assets. You could even start with a few percent. Just get started, dollar cost average into it. We're also starting to see the miners catch up. Our tools that John shared some of them earlier, our tools that measure relative strength of one asset versus the other, tell us that miners are leading bullion, and within bullion, silver is leading gold. So don't forget to have some miners. Our model has 10% miners, 2.5% silver right now, and we're watching it closely. And these are big, big base breakouts that go back many years, as you could see just a minute ago on those monthly charts. So if you, by the way, now let me talk about the other side of the coin really quickly. We've had a number of conversations with clients that have 50 or 70% gold and silver. Even though that's not our recommendation, a lot of people are very heavily overweighted. Don't forget to sell on the way up. And I know that might sound contradictory, but it's not really meant to be. If you're one of those people that's been buying since 2002 or something like that, and you're very heavily overweighted, the fact that I said we've reached near-term targets here and we're likely to go sideways or consolidate for a little bit of time. Good time to start selling a little bit and do the work on the house or the big dream vacation or whatever. We've had a lot of conversations. People just need the mental nudge to sell some and use it because that's the whole point anyway. If you never sell any, what's the point? So that's my take on the metals here. And I think that we're probably in a trend that will last for quite a while.
Okay, so you're not seeing anything there that had you guys worried that this bull rally in the precious metals is in any danger. So that's, I'm sure, relief to folks. If you are one of those folks that Mike just mentioned who's got 50 to 70% of your net worth in the precious metals, I'm just going to say if you have that much of your net worth in anything that goes in violation of long history of best practices for investing, you are overexposed. And at a minimum, you should be hedging that position. And as Mike said, probably, should actually be taking some of those gains, turning them from unrealized into realized. You still keep a good chunk of all that. But, history is replete with people that were all in on a bet, felt like geniuses, and then, saw a lot of that wealth vaporize when the market turned. So just do yourself a favor and look into ways in which you can reduce your level of exposure there that makes sense for your long-term goals. And again, if you want to get a professional's advice, and that I'm sure John and Mike and the team there at New Harbor would be happy to tell you what they think for free even. All right, so gents, we got to wrap up here. John, I'll give you one last question before I tie things up. You guys talked to real people, real investors, the folks that watch this channel all the time, whether they're existing clients or whether they're folks that have reached out for a free consultation with you. Is there anything in particular you're hearing right now in terms of either concerns or aspirations that are worth talking about?
I think we continue to hear a sentiment, and understandably so, that folks are confused, right? Markets have gone through a rapid decline followed by a rapid rise, and none of it makes sense. And this is why it's really important to, and I just did a little video to educate, like how headlines oftentimes misdirect, and sometimes intentionally for their own self-serving purposes. The headlines can invoke the opposite, reaction than one should be partaking in, and that's why it's important to really have a data-driven process that focuses on what is rather than what the narrative is being talked about. So that's been a big central part of our conversations with clients. But it's just always bring it back. We're in the business of working with real people. We're not a mutual fund trying to get new dollars by flashing up, performance numbers on the latest, advertisement in a newspaper or internet. Our work brings money back to people's real lives, and that's what is the money should be in service of that, not to boast to your neighbors that you beat the market, or you owned 50% of your portfolio in Nvidia or whatever, or Bitcoin. It's really about what this means to your life, and that's what we excel at.
Okay. And I just want to underscore on that last point, something that I've just been hearing more and more of the experts on this channel remind folks, which is, especially if you've got some assets, if you get specific about your life goals, your financial goals for how you want your money to help you enjoy life, whether it's to hit a retirement by a certain age or to build that dream home or whatever it is, John. If you get specific about that and then do the backward-looking math and say, okay, if I want to be here by time X and I'm here now at time Y, what kind of return do I need to get from here to there? Oftentimes it is less than what the market return is, and that means you can get there by taking less risk. And the fact that far too many people don't do that and therefore end up taking on too much risk or more risk than they need to try to hit their goals. It's kind of crazy when you think about it. This should be just an easy math decision, and who wouldn't want to get to their goal with the least amount of risk possible and the most amount of restful nights with a minimum of volatility and nail biting and all that type of stuff. So if you haven't done that work recently to reevaluate your financial goals, highly recommend you do that, because especially in a market like this, which is richly valued, meaning the odds of some sort of material price correction are higher than normal, managing risk is just a key part of getting to where you want to go in life by the time you want to get there. John, you're nodding as I'm saying this.
Yeah, that's absolutely right, Adam. And I just want to emphasize, this is hard. It's not easy. These decisions, and even the decision to sell some gold if you have a lot of it, these are hard decisions. We don't mean to belittle. They're hard because they're emotionally entwined decisions, and that's perhaps where a friend or a family member or advisor that you trust can be most helpful to help you, recognize some of the sticking points in your own thinking and challenge it a little bit.
Yeah, and this is where behavioral economics comes into play, and it's why I find the field so fascinating. Is we should make exceptionally rational decisions around money because it's so quantifiable, and we make exceptionally irrational decisions more often than not because it's emotional for us. We're human animals that are driven by our emotions. So to your point, John, anything we can do to kind of get the emotions out of the picture and just look at it kind of like a Vulcan, the better for us. All right. Well, John and Mike, thanks so much, guys. I do want to, in closing here, give you guys a shout out. So I was just at Rick Rule's annual symposium in Boca Raton. Wonderful event, despite being real hot and humid down there. But I got to meet so many thoughtful money viewers. I mean, it just shocked me how many people came up to me. There were times where I would literally try to cross a room and it would take me about a half hour, because after I talked to one person, I'd take another step and somebody else would come up and say, hey, I just need to tell you, very much appreciate the program and all the guests you have on there. And I got a lot of great kudos, and honestly, I felt bad for that, because so much of it really should be going to the people that join me on this channel. but it came up a fair amount of times that not only do people really enjoy invest. Folks, I'm sorry for the abrupt ending there, but we had a technical glitch during the recording with John and Mike there, and we somehow just lost the end of that discussion. Now, we were in the last couple of minutes and just wrapping up. Right there at the end, I was really just thanking John and Mike because I'd been at this conference for Rick Rule and had a lot of people kindly come up and thank me for everything that Thoughtful Money does. I wanted to let John and Mike know that a lot of the people that walked up to me were either clients of theirs or had had a free consultation with them, or just watched them every week on this channel and just had a lot of appreciation for them. So I wanted John and Mike to know that they are very much a very valued and very important part of what Thoughtful Money is. So anyways, we had ended that discussion with good feelings all around. So anyways, folks, thanks for making it all the way to the end of this video here. If you enjoyed having Michael Pento on, would love to have him come back on again soon in the future. Please let us know that by hitting the like button and then clicking on the subscribe button below. As I've been saying recently, please do just take a second and click that subscribe button if you're not already subscribed to this channel. Please do it for 3 reasons. One, I'm really trying to hope we can get to 150,000 subscribers by the end of this month. That's my birthday. I'd love to celebrate on my birthday, hitting that milestone. But more importantly, if you click that subscribe button, you'll be alerted every time this channel produces a new video, so that way you won't miss our content going forward, so you benefit. And this channel benefits if you click that button because YouTube gives this channel more love the more subscribers it has. So again, about a second's worth of effort on your part, and it helps the channel, helps me celebrate a good birthday milestone, but it also hopefully helps you as well. So all right, well, in wrapping up here, you know, both Michael Pento and John and Mike, you know, gave us a lot of fodder for thought in terms of how, you know, rocky and you know, potentially risks to the downside that the future has here. And so highly recommend, in terms of figuring out how to navigate your financial capital through all that, you benefit from the guidance of a good professional financial advisor, ideally one that takes into account the macro issues that Michael mentioned and that John and Mike talked about. If you've got a good one who's doing that for you, great. Don't mess with Success. You should stick with them. But if you don't, or you just like a second opinion from one who meets that criteria, then I highly recommend you consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. As a reminder, these consultations are totally free. There's no commitment to work with these firms. If you want to talk to John and Mike directly, you can specify that when you fill out the form. These firms just do it as a free service to help as many people as possible. With that said, I want to thank John and Mike for joining me for another great week. I want to thank Michael Pento, obviously, for a fantastic discussion he just gave us. And to all you who are still watching, thanks so much for hanging in here. Thanks so much for watching.